Have you tried options trading and failed miserably? Maybe you've never started because the word conjures up horror stories of over-leveraged portfolios and massive losses. If you're in the first camp, you're not alone. And if you're in the second, you're not wrong. Options are incredibly complex financial instruments. To trade them successfully, you need to understand their variables, risks, and strategies. Information typically acquired in advanced level courses. And as many retail investors discovered during and after the pandemic, they are hard to get right. But what if I told you that you could profit from options without ever trading a single contract? In fact, without understanding more than just the basics. Follow along as we explore what makes options so risky, and how average investors like you can use those risks to your advantage. Options sound deceptively simple at first, especially if you've only seen beginners' breakdowns. However, such resources often fail to convey just how complex options are, or the risks they present to your portfolio. Let's look at some of the most common risks retail traders encounter, and later, how even beginner traders can mitigate these risks. 1. They are not familiar with the jargon. Later, we'll cover a few terms options traders should know to succeed, but truthfully, we'll barely make a dent. There's too much to explore in one video. Underlyings, moneyness, delta, implied volatility, long strangles, iron condors. If your head's already spinning with all this jargon, don't worry. We've compiled hours of options research into a comprehensible downloadable guide for beginners and advanced traders, so you can learn all you need to know about options regardless of your experience level. It's free to access. You can find it in the link in the description. 2. They don't understand options pricing. Like stocks, options prices can move on fundamentals and market sentiment, but also complex features like theta, gamma, and changes in volatility. If you don't understand all the factors that influence premiums, or how those factors impact your chances of taking a profit, you're injecting extra risk into an already risky asset. 3. They don't understand the role volatility plays. All asset classes are affected by volatility, but unlike other securities, assumptions about future volatility are a direct function of option pricing. Understanding just how volatility impacts options pricing and performance takes some doing. Trading on that volatility takes advanced knowledge and high-tech help. 4. They don't understand the role of the Greeks in options trading. The Greeks, symbolized by Greek letters, represent pricing sensitivities to option risk factors. For instance, delta is the first derivative risk that measures the rate of change between an option's price and the underlying price. Another essential Greek, gamma, is the second derivative risk that makes options pricing dynamic because it examines the non-linear aspects of options pricing. Specifically, gamma measures the sensitivity of an option's delta to changes in the underlying's price. Plus, you have theta, vega, rho, and that's just a sampling of the risks and jargon successful options traders have to master. 5. They trade too aggressively. If we learned anything from the pandemic GameStop incident, it's that getting caught on the wrong side of an aggressive trade can cost you. Too often, less experienced traders try to hit home runs by betting big on contracts with a low probability of success. Or just the opposite, they fail to understand how much they stand to lose when prices move against them. Many options traders also risk too much of their options accounts at once, making them unable to sustain short-term swings in trading results. That's where a solid knowledge foundation and strong data-backed tools come in handy. 6. They don't know how to manage their risks. Managing risk is key to any investing strategy. But in the fast-paced options environment, balancing risk, reward, and fear gets complicated quickly. To start, many traders fail to diversify their options trades. Take those who were short Facebook puts in 2018. They couldn't have predicted that the Cambridge Analytica scandal would drop the stock 19% in a day. Yet, overexposed traders still suffered massive losses. Many traders also enter options with no clear exit strategy, choosing to stay put when they should get out. Some suffer from what we call blow-up risk, meaning they dive into badly managed short positions and fail to bail in adverse market conditions. We saw this a lot at the start of the pandemic. Many traders failed to adjust their positions quickly enough, and when the market moved against them, they suffered massive losses. Similarly, they may not know when to break their exit strategy, when it makes mathematical sense to exit a profitable trade early, or ride their contract to expiration. Fortunately, you don't need to rely on yourself to make these decisions. You just need the right tools. 7. They don't understand options trading strategies. Trading options effectively requires understanding a complex set of strategies. However, research shows that retail investors are more likely to stick with simpler strategies that are difficult to consistently profit from instead of, for example, using multi-leg strategies like iron condors. Even if you're familiar with the more popular strategies, like vertical spreads, you may fail to consider all the variables, like whether a trade properly compensates you for taking certain risks, or foregoing the potential upsides, or an alternative trade. How to profit from options data without opening a contract. I've thrown a lot at you already, and so far we've barely scratched the surface of options risks. But for all their complexities, options offer a silver lining for even the most inexperienced investor. As a numbers-heavy field, options generate a lot of data. And if you know how to tap that data, you can trade on options without buying a single contract, at less risk. How? By leveraging visual sectors to take your trading game to the next level. Of course, if that doesn't sound great, you could always go back to trading options yourself. If you choose to go that route, however, you're going to need to know a lot more about options. What are options? We've established that too many people dive into options without understanding their nuances and challenges. So let's quickly refresh on options and the role volatility plays. And if this quick explainer doesn't scratch your itch, remember to click the link to our free options guide in the description below. What are options? Options are non-linear derivative contracts whose values are largely based on the named underlying security. Underlyings can take many forms: bonds, commodities, interest rates, but we'll stick with stocks and ETFs. Options contracts come in two types: calls and puts, and may be used to speculate on price movements or hedge against risks elsewhere in your portfolio. Regardless of type and purpose, all options contracts involve two parties. The buyer or holder buys the contract, and the seller creates or writes the contract. American options, which we'll focus on here, give the buyer the right, but not the obligation, to buy or sell 100 shares of the underlying on or before the expiration date at the strike price. If the buyer exercises their option, the writer has the obligation to deliver or receive the underlying. To acquire an options contract, the buyer pays a premium to the writer. The premium's value depends on 5 factors: moneyness, time to expiration, the dividend yield of the stock, the prevailing risk-free rate, implied volatility. This last point is particularly important and complex, so let's take a closer look. The link between volatility and options in general. Volatility describes an asset's up and down price movements. Stocks with higher volatility show wider dispersions, or larger movements above or below an expected value. To understand an asset's volatility, you usually look at its historical volatility or past dispersion. But when it comes to options, we're more concerned with how the market expects a stock price to move during a contract's lifespan. This is known as implied volatility, and it's a big deal in the options world.
So what is implied volatility? Implied volatility represents the standard deviation change in the underlying price. One standard deviation represents a 68% probability that the price will sit within a specific range within 1 year. In simpler terms, implied volatility reflects market sentiment or investors' perceptions about future price risk. However, it doesn't tell us what direction prices are expected to move, only by how much. Implied volatility, or IV, is what's known as a latent variable because it's inferred instead of measured. By contrast, time to expiration is what's known as an appreciable variable because it can always be measured. Once you know the IV of an option, however, you can use it to gauge the expensiveness of an option, determine whether markets are expecting higher or lower price swings than normal, and even make trading decisions. However, it's important to remember that implied volatility doesn't guarantee future price movements, and since many traders trade volatility metrics, their expectations can actually impact price movements. And all that's just a start. No wonder options trading can seem so difficult.
Options aren't optional, but their risks can be. When used carefully, trading options can help boost gains and manage risk. But even for experts, options trading is risky. The chances of achieving long-term profits as a retail trader are hardly better than rolling a dice. Fortunately, there's a better way to win with options, by trading on the data they generate without opening a position yourself. But that's a video for another time. If you can't wait until then, remember to click the link below and download our free What You Need to Know About Options guide. And don't forget to subscribe and hit that bell. See you next time.